Welcome to episode 2 of Willow Oak's Value Hour, a new program where we talk all things investing with Willow Oak's managers and partners. Today, we'll be discussing some of the issues fund managers and investment professionals are facing due to market volatility and the investor insecurity that we're seeing right now. I'm Jessica Greer, Vice President of Willow Oak Asset Management. And joining me today are Shana Sparber, Sarah Williams, and Rusty Planert. They are each CPAs and managers with Wipfli's audit and accounting team. This team is a versatile team that works with all types of investment partnerships, from mutual funds to commodity pools and private equity funds. With more than 2,400 associates and 50 offices, plus more than 100,000 clients, Wipfli ranks among the top 20 accounting and business consulting firms in the nation. Thanks so much for being with us today, guys.
Thanks for having us.
Thank you.
I can speak from firsthand experience that the team at Wipfli is a real pleasure to work with. They make it as unbelievable as it seems. They make it easy to walk through the audit and tax process. And that's no small feat to kind of say on the other side of things that it was painless, relatively painless, and done with a lot of precision and professionalism. So thank you so much for that and for being such a good service provider and partner for our team at Willow Oak. As many of our viewers know, Willow Oak's fund management service team works with boutique fund managers to provide the operational support that they need to stay focused on the portfolio, thereby adding great value to our investors. We handle the logistics, all of the day-to-day operations, from investor relations to marketing and compliance, and in so doing, have had the great pleasure of building really strong relationships with providers and partners like Wipfli. So before we jump into things, let's get a little bit of perspective on who your clientele is. Can we talk a little bit about your clients? You have 100,000 clients nationwide. You guys are undoubtedly working with funds of all sizes and strategies. Can you speak a little bit about the funds you work with?
Yeah, happy to. Yeah, so I always tell people that if you're looking to pool the money of 2 or more investors together to invest in something, Wipfli can help you with the audit and tax work for that. So here at Wipfli, we audit over 300 investment partnerships, including hedge funds, commodity pools, private equity funds, and venture capital funds. And then those managers won a wide range. You have your managers with about $1 million under management and all friends and family money, and then ranging up to managers with over $1 billion under management and mostly institutional money. But I'd say that our sweet spot client is really the $5 to $25 million emerging managers. So we find we're able to provide really a lot of value there. Maybe they have the investment aspect figured out, but they're new to an audit or new to the fund structure. And we're more than happy to get on the phone with them, have a conversation, and walk them through all those things. And so to this point, I have a client that I just finished an audit with. Actually, yesterday we wrapped it up. They've been with me since their inception in 2017. At that time, they were about $8 million. And as of April 2020, they are north of 150 million. They just registered as an investment advisor, and they just crushed March. So it's really good, really enjoyable to work with clients like this and watch them grow.
Yeah, wow, good for them. Yeah. And given the breadth of your clientele, can you speak a little bit about how this new remote working environment has maybe impacted how your teams are operating or even product deliverables for your clients?
Yeah, in regards to remote work, for the most part, Wipfli's asset management industry was already set up to work from home, and most employees at least partially worked remotely. So the transition was really smooth and didn't have a significant impact on deadlines or production, thankfully.
Oh, that's great. Yeah, at Willow Oak, we run a 100% virtual office. So thankfully, we had kind of a seamless transition as well, other than the fact that I personally am the mother of 4 kids, and I often have a young one kind of walking behind me, strolling behind me in a conference call, but there's been a lot of patience and understanding overall. So that's great. So wonderful. Then I'll throw this one out to the team. In your communication with fund managers and other service providers, what are some of the effects that COVID-19 is having specific to the fund entities and their operations?
Yeah, I'd love to address that one. The effect that COVID-19 and the resulting market stress is having on funds varies significantly depending on the strategy and type of fund. From what we are seeing at Wipfli, the opportunities that are available to fund managers partially depends on the flexibility they have included in their organizational documents, as well as what compliance regulations they are subject to. Some of our funds have been concerned about being hit with an influx of redemptions. Others are concerned about how to stay compliant when, for instance, information required to produce their reporting is not readily available. On the flip side, we've also seen an increase in startup funds as managers are trying to take advantage of slices of opportunity in the market. For these new funds, managers are wondering what are things they should consider when developing their fund and putting together their fund documents. How can they prepare their documents to be flexible enough to address any market? And this brings me to some of the similarities we've noted from fund managers that seem to be performing well in this market. First off, it seems they all have a level of flexibility in their strategies, which allows them to make timely changes with their environment. Secondly, they seem to have a capability to utilize technology to stay actively involved with their investments. And finally, they have the intuition to find those market segments, providing new opportunities, which are often available in stressed markets.
Yeah, it just speaks, I think, to the importance of getting it right from the start, right? You can't go back, you can't change your PPM, you shouldn't, certainly. And so how often are you guys involved in the process right from the get-go?
Yeah, I think we really enjoy to be part of that partner. When we talk to new kind of emerging managers, we love to look at draft documents before they're inked and signed and finalized. So we really do enjoy maybe advisory or just those conversations that you can have from the very beginning and maybe even pre-beginning. And I think that can be a really good way to lay the groundwork for a solid relationship and less headaches going forward.
Certainly. That's great. So Sarah, you mentioned, some funds experiencing some investor insecurity, redemptions, given liquidity constraints, investor insecurity, all of it. I think some funds are more vulnerable to an influx in redemptions. What options might a fund want to explore if this is the case?
Yeah, and some of my clients are expressing those concerns right now. I think the first thing I tell them is to really make sure that they have a detailed understanding of their offering documents. They might have some gates, maybe a fund level or investor gates, or even some defensive notice provisions that can be helpful to them. I mean, those gates, if they have them, will help slow redemptions down without putting them to a halt, which might be beneficial to the investor. Those gates are ideally designed to be equitable, to not really encourage redemptions, and to maintain fund value. Sometimes they are discretionary, sometimes they're mandatory. But even if you don't have a gating option, I would say to really be careful about your notice periods and to make sure you're really understanding that process as well, and to make sure those notice periods are consistently applied. So recently, 2018, I think the SEC had an order against ARIA partners. They had, like many, a formal redemption notice period of 90 days. Informally, they sometimes allowed a 60-day notice period. And those differences in that redemption practice, and especially the lack of proper disclosure, and some other potential findings led to $150,000 monetary penalty. So I would say just be really careful with those fund documents. They probably have some options available to you, but utilize counsel when you need it as well to make sure you're really consistently applying what's in those documents.
And Shana, on that point, if the PPM is written in such a way where you know, any type of relaxing of the terms is at the discretion of the general partner, what then is, you know, what's then to stop them, or where's the caution then? I mean, is it in documentation? Is it in consistency across limited partners? How does that kind of shake out then?
Yeah, and I think they need to be careful about how far they push that discretion, because I think in partnerships, what I like to say is what's good for one partner often is harming someone else, and you still have that kind of level of fiduciary responsibility that you really just have to be careful about how you're exercising it. So I would be cautious about even if you have those words, because everyone does, everything's at the discretion of the general partner, to be careful how far you go with that, especially when you become registered and have some of those SEC oversights to you. But even ideally before that, just I think the way that you want to treat your partners, consistency is usually the best practice as much as you can adhere to that.
Yeah, absolutely. And I know at Willow Oak, the funds that we work with, none of them are registered. We do work with an RIA, but we do try to operate in the spirit of what
Exactly.
it looks like when we are when we are kind of under the strict
microscope. Yeah.
Yeah, right. Better to get it right now.
Right. Yep.
Right.
So some funds might have the option to make a distribution in kind to a redeeming partner. Can you speak a little bit about the potential benefits of this and what the tax implications might be that go with it?
Sure. I have some of my clients who go that route, and they see that there's some advantages to providing some investor liquidity to do in-kind distributions while still maintaining fund value. And what I mean by that is maybe some funds have 10 or 20% of their investment portfolio in something illiquid, and I would even say illiquid is thinly traded. And so if a fund is experiencing a significant redemption and they're looking to sell part of that thinly traded illiquid investment, if it's a big chunk, they might really need to do so at a discount. And so that's really not great for fund value, especially those remaining investors and that exiting investor as well. So on the other hand, a fund manager might decide to really just liquidate more of those liquid investments to meet that cash flow need. And that might work well. But fund managers also might feel like then their mix, their investment portfolio, their allocations are shifting to more of an illiquid side than they really were intending. And so another thing to consider is would that redeeming partner, would you want to distribute those less liquid shares to them pro rata? So maybe their distribution is part cash and part shares. That could be an advantage to kind of keeping that investor liquidity, keeping equity between partners, and really keeping fund value. So again, look at those fund documents. Is that something that you can consider? You know, always there are some headaches associated with it and maybe some incremental costs. So you'll want to really be thoughtful about it. And as you mentioned as well, there's also some tax implications. I think Rusty, were you just dealing with this with one of your clients?
Absolutely, yeah. So we do see this from time to time, and there are tax implications and potential benefits as well. Obviously, there's, as you discussed, there's going to be some increased compliance costs. There's some additional disclosures that need to be made and some additional work that needs to be done to make those. But the important thing to note is that oftentimes in-kind distributions are not considered a taxable event. And this is not all instances, but I would say most instances of redemptions in kind are not a taxable event. So the investor would acquire the shares, they'd acquire the holding period and the cost that the fund had in the shares. And then whenever they eventually sold those shares, that's when they would recognize gain on those shares. So there is a bit of a benefit to be gained as well by doing redemption in kind, delaying those gains. But it's important to make sure you discuss any redemption in kinds with your tax advisor ahead of time. We encourage you to be proactive. So you know, all these instances are not the same, and so you need to discuss those with your tax advisors to make sure that there's not something that's getting missed there.
And just to be clear, then this optionality of doing kind of in-kind redemptions does need to be included in your offering document.
Yeah, you need to have the ability to do so. That's exactly right. Yeah. And that's why we go back to the flexibility that Sarah was talking about.
Yeah, it's so key. And it's considering all of these scenarios that you might not think about in kind of the rose-colored period of
it's
time.
another tool in your toolbox.
It's gonna be wonderful. Yeah. All right. Well, as we know, an audit carries a lot of gloom and doom in the word itself sometimes. Sorry, guys. But it can be an intimidating undertaking, no matter the circumstances. So presently, are there any direct effects from COVID-19 on the fund's audit process at this point?
Right. Yeah, one new requirement all fund managers must be thinking about is the need to evaluate the potential impact of COVID-19 on the financial statements. So all of Wipfli's funds that have not finalized their financial statements for 2019 are considering adding a disclosure about COVID-19. In most cases, the effects of COVID-19 are not quantifiable to the fund, and their disclosure is simply that they cannot identify whether there will be a material adverse effect on the fund's operations, and that they feel it's not possible to reasonably estimate the financial impact COVID-19 may have at this time. Shana, do you have anything to add to that?
Yeah, I think I would start thinking about 2020 as well. I know people would love right now to think about their 2020 audits, but we should also be thinking about that. And I think as auditors, we're going to be talking a lot about internal controls. And so we think about the whole year, 2020, when we talk about internal controls. And I know, Jessica, you said you're really business as usual. And I think Sarah, Rusty, and I were kind of in the same boat, but I've really been hearing for a lot of people, it hasn't been business as usual, and their process has really got upended in the last few weeks, months, whatever this is. So I think fund managers for themselves, but especially for their service providers, need to understand how those internal control changes have impacted their fund, and just to make sure that they're really still solid and effective. On some level, I'd probably say the same thing about risk assessment. Fund managers might even want to document some of the risks that they're thinking about, maybe market risks, cybersecurity risks, whatever those are, and be clear and be able to articulate how they're mitigating those risks. I think auditors are always thinking about processes and risks, but you're going to be hearing those a lot in 2020.
Yeah, sure. I would say compliance, generally operational fortitude has been brought to the forefront in all of our minds. So on that point, what compliance relief has been offered to RIAs, CPOs, and CPAs?
Yeah, that's a really good question, Jessica. We found this to be a significant issue for some of our fund managers. Concerns for family health and well-being need to take the forefront right now. So not to mention that managers are dealing with delays in information. With all that, the SEC has stated that prompt and complete disclosure is crucial to functioning markets, but they do acknowledge that some investment advisors will be prevented from meeting their regulatory deadlines. Presently, the SEC has provided a 45-day extension for registered investment advisors and exempt reporting advisors incapable of meeting their filing requirements previously due between March and July. Originally, the SEC expected investment advisors to provide estimates for when they expected to comply with the filing, as well as explanations for why they needed the extension. However, now they're just requiring notification. Similarly, the National Futures Association, or NFA, has issued reporting relief for member commodity pool operators and commodity trading advisors. In general, similar to the SEC, the NFA is providing 45-day reporting extensions for reports due in March through May. And then in regards to distributing audited financial statements, the SEC doesn't plan on issuing any official extension to registered investment advisors. However, they have indicated that they would not recommend enforcement action for a violation due to certain unforeseeable circumstances. Managers should document their reason for missing the due date and definitely consider having this documentation reviewed by their legal counsel, as I think we've said about other things as well.
Yeah.
When in doubt, document, right?
Yeah,
Right.
exactly.
And on the tax side, can you talk a little about the extensions for filings? Obviously, we know there's been extensions put in place for the 2019 tax year. Do you foresee any changes in the 2020 tax calendar?
I would say presently there are no expected changes in the 2020 tax deadlines. And right now, regulators seem to be only concerned with the next couple months. But obviously, there's a lot of unknown as to the lasting effects of what we're going through. So,
for sure, for sure. Okay, well, great. Let's switch gears just a little bit. Sarah mentioned that Wipfli has seen some new startups as a result of the current market, and that's a particular specialty for Willow Oak as we've launched funds and work with a number of emerging managers. I think this is a near and dear issue to a lot of our audience as well. So what's some advice you can provide a startup fund in regards to some of the things they should be considering when developing their organizational documents?
Yeah, I can jump in there. So I think Sarah mentioned flexibility earlier, and that's important. You want to have the ability to protect your portfolio in any way possible when the time comes. So start there. But in terms of what are investors looking for when they're picking up your offering documents, I'd say the first thing they're going to be looking toward is your fee structure. The first fee I want to talk about is management fee, and this is an asset-based fee that's charged on the fund's net asset value, otherwise known as partner's capital. It's typically charged on a monthly or quarterly basis and is in range of, I'd say 1% to 2% is typical. There's times when the management fee is not charged, and then almost in all of those scenarios, you're going to see the other fee I want to talk about, which is the incentive allocation. And so this fee is the profit-based fee, typically ranges between 10 and 25%, and it can be either charged as an allocation, a reallocation of capital from the LPs to the GP, or it can be charged as a fee. And we strongly recommend the allocation. The Tax Cuts and Jobs Act removed the deduction for the expense in the 2017 legislation. And another important thing to note about incentive allocations is they're often subject to high watermarks or loss carryforwards, which would require a manager to make up for any losses before an allocation would be charged following a down year. And then, managers are really looking for any ways they can to sort of differentiate their fund and their fee structure from other funds. And one way we're seeing pretty commonly nowadays is the hurdle rate. So hurdle rate is basically it's a rate of return that's required before the manager is able to charge an incentive allocation. And this can be done in a number of ways. One we see, which is a little less common than the other, would be the soft hurdle rate. And it's essentially, if the hurdle rate's achieved, then the full allocation is taken. So, in a scenario where you have a 5% soft hurdle and the manager gets a 6% return, they'd get an incentive allocation on that full 6%. Another option would be the hard hurdle, which only gets you, the manager only charges the incentive on the portion over the hurdle. So in the previous example, 5% hurdle and a 6% return, they would only get an incentive allocation on that 1% over the hurdle. And it's easy to see why this is attractive for an investor. These hurdle ranges typically range between 4% and 6%, but it may make more sense to align your hurdle rate with some sort of index that aligns with your strategy, maybe the S&P 500, or let's say you're focused on China, maybe the MSCI China index makes a lot of sense as a hurdle rate. Outside of the fee structure, I would say the most important thing for an investor would be your redemption policy, how often they can redeem, how much they can redeem. Shana mentioned the withdrawal gates earlier, and those are important. Another option would potentially be a lockup. It should align with your investment strategy. It doesn't make a lot of sense in a trading fund, but in a buy and hold fund, a lockup can make a lot of sense. Maybe between 1 and 3 years is typically what we're seeing. And again, it's important to make sure that all of these fees and these policies align with your investment strategy. And then more importantly, just to tie this all together, by far the most important thing is if you're having conversations with prospective investors as you're talking to your attorneys and having these documents drafted, you want to make sure that the documents that you're eventually going to show them align with the words that you're telling them. To this point, I finished up with a prospect a couple of weeks ago, and having conversations, and they're explaining to me how their incentive allocation works. They're explaining to me how their fund works. It's a hedge fund, and then I go and take a look at the offering documents, and the verbiage is very similar to what you would see in a private equity fund. It's a distribution waterfall. A private equity fund where they're going to hold the investments for years, 1 or 2 investments, and then sell them and distribute them all at once. That type of incentive allocation doesn't make a whole lot of sense in a hedge fund, but more importantly, like I said, he's having conversations with prospective investors and telling them one thing. You can imagine how awkward it would be if he presented them with an LPA that said something different.
Yeah.
So
right.
these are important conversations to have.
Yeah. Very much so. I feel like we could have another whole session on fees alone and how to structure. And I think that's a really important point, that sometimes we think of kind of the fees separate from the investment portfolio, but really they need to, there needs to be, they need to complement each other. They need to reinforce one another, something along those lines. I mean, if for nothing else, the conversation about the redemptions and how, less liquid portfolios can be so harmed by just the redemption structure that you put in place right from the get-go that doesn't get considered maybe.
Exactly right. Great point, Jessica.
So, staying within the realm of considerations new funds should be thinking through, what are some of the tax implications a fund could face due to the investments they make?
Yeah, well, probably tax concerns do not always take priority when making investment decisions. There are a few investments with significant consequences that fund managers should at least be aware of. One of these investments is a publicly traded partnership, or PTP. We have seen several funds make 1 or 2 small investments in a PTP unaware of the tax effect of doing so. These funds are usually first surprised by the effect that they have on the timing of taxes. The fund receives a K-1 for each of these entities and is thus dependent on when these are made available. In addition to the timing, PTPs complicate tax allocations significantly. And so they can cause an increase in the price of preparation. And one other aspect common to PTPs is they often include income in various states, resulting in additional state filing requirements for the fund.
Yeah, I can add something there. I just finished up with a client. They invested in 1 PTP, and because of the one investment in that 1 PTP, we filed in 12 additional states. So I just to show how much this can really add to the complexity of a return. These are things we're happy to do, but just something to know.
Yeah.
Right. And then another area would be foreign investments, especially when the fund's investment exceeds a 10% ownership. These could include investments in controlled foreign corporations, passive foreign investment companies known as PFICs, foreign partnerships, or just simply having an investment in a foreign financial account. Foreign investments have additional filing requirements and are subject to different tax treatment. Just recently, I had one fund that was not aware that they had invested in a PFIC. So for this fund, the possible consequences of a PFIC investment was enough to make him sell the investment at his first opportunity to do so. So just know ahead of time. And another complication to be aware of on the tax side is in regards to any foreign investors you might have. At the very least, you will likely need to withhold on any dividends allocated to them. But yeah, just most importantly, I would really advise discussing your investments and the investor information with your tax advisor beforehand, because each situation is unique and planning ahead, I think, can make a really big difference.
Yeah, for sure. Avoid surprises. That should be everybody's motto, right? Well, this has been a really helpful conversation. As tragic and scary as this pandemic has been, it's revealed a lot of areas where we've perhaps made ourselves vulnerable to operational risks that we hadn't considered. And now we have an opportunity to address them. I know a takeaway that I have is to be much more in touch with our tax and audit team throughout the year, and not just during tax season. I'd open the floor to you guys for any closing thoughts, and again, add my thanks for all the support you provide to our team.
Absolutely. So you hit the nail on the head, Jessica. Clear, proactive communication is absolutely key. We always tell our clients, we don't know what we don't know. The sooner you make us aware of potential problems, the sooner that we can help you to resolve them. So, what we always say here at Wipfli is, we're always happy to have a conversation. So please pick up the phone, give your auditor a call. We're happy to have that conversation, help you out.
Especially if they're clients like, especially if they're clients like you, Jessica. You're a pleasure to work with, and this we enjoy that immensely.
Love talking to the clients.
Exactly. Yeah.
Thank
you so much.
Yeah, well, thank you very much. And thank you for joining us on this episode of Value Hour. To our viewers, don't forget to subscribe to Willow Oak's YouTube channel and follow us on Twitter to get notified of future events. If you'd like more information on Willow Oak or Wipfli, please email me at jessica@willowoakfunds.com. Thanks again.
Hey, thanks
Thank
so much.
you.
Take care, everybody.